Hello, and thank you for joining us. This is Eric Chung from State Street. Globally, private markets has been a growing asset class over the past 5 years. In fact, total capital raised in the last 3 quarters of 2021 has surpassed the entire year of 2020. We have noted that despite COVID, the pandemic did not cause any confidence issues as investors continue to allocate into private markets. No surprises there. Private equity, consisting of buyout funds, lead with a total of more than $270 billion raised, followed by venture capital raising more than $75 billion. And private debt as an asset class garnered $30 billion, but has been increasing exponentially, according to data from State Street. With the recent rate hikes, the changing geopolitical environment, we are seeing both private equity and venture capital valuation showing early signs of stress. Now, as investors seek returns and diversification, they are turning their eyes into real assets and credit as a strategy and has been garnering more interest. Within Asia Pacific, we have seen similar trends. Data from Preqin reports suggest that private debt markets will continue to grow double digits. And this is tipped to reach as high as 2.7 trillion of asset under management by 2026. The macro environment will no doubt present challenges along the way for both investors and managers, and we expect competition to rise within this space. Joining us today is an esteemed panel consisting of Wee Yap from Seatown Holdings and Nitish from Orion Capital. I will have them first introduce themselves before we start the discussion today. And Wee Yap, over to you.
Sure. Thanks, Eric. I'm Wee Yap from Seatown. So Seatown is ultimately a wholly owned subsidiary of Temasek Group. Currently, we are managing $7 billion of AUM. We launched our first private credit fund that accepted third-party capital back in December 2019, and we'll be launching our second fund later this month. We are an Asia-Pac focused fund, and basically we are targeting the performing loan segments of the market. So our typical deal investment size is about $50 to $120 million. Thanks.
Nitish.
Thanks, Eric. So again, I'm Nitish Agarwal. I'm the CEO and CIO of Orion Capital Asia. I have been in Asian credit markets last 25 years and started this credit platform 10 years ago to focus on performing credit. We invest across Asia Pacific, and we do both with sponsors and non-sponsors. And our focus is really more middle market. So I think the typical deal sizes we do are up to, I think, $75 million. We try not to go beyond that in terms of the middle market lending that we do. And over the last 10 years, we have invested more than $1.5 billion in performing credit across Asia Pacific.
Thank you both, Wee Yap and Nitish. Truly a very high-powered and high-caliber panel that we have today. And so let's get the show on the road. We'll start by first asking you perhaps the most difficult question. We have lived through COVID. Geopolitical tensions are rising across the world. And the rate hikes triggered by Fed is leading to a round of rate hikes across the world that we're seeing. There are a lot of uncertainty in the markets. So maybe I'll invite you guys to start sharing with us what is your view on the macroeconomic environment and how has it helped shape private credit as a strategy from your vantage point. So let's start with Wee Yap first.
Sure. So I think it's probably be helpful to basically try to break up the Asia markets context into pre-COVID, which is more of a normal market situation, and subsequently fast forward to the current market situations. So pre-COVID, what you see in Asia is that Asia has been a market that's been growing at a faster pace than the developed market. And that basically leads to strong demands for growth capital to support CapEx spending, growing businesses and companies doing M&A. And the availabilities of capital in the private credit in Asia has generally been at a very much lower base as compared to the US as well as the Europe market. So it has been quite a good place to do private credit because there's much less competition. The pricing that we can obtain in Asia generally has been much higher than the US and European markets. And in terms of deals, structures, and the deal terms, generally in Asia, the deal terms are generally much tighter. It's closer to the banks-like terms in Asia. Generally, for example, for financial covenants, it tend to be maintenance-based rather than incurrence-based. And you see that the overall leverage that a borrowers can take in Asia generally has been at a much lower level as compared to the US and the Europe market in recent times. But Asia is also a very much more complex environment because this is not a homogeneous market. Each country has its own language, regulatory laws, market dynamics, and business community. And some of the deals that in Asia, you have to cross multiple jurisdictions. So to operate well in Asia, generally the team basically need to have deep localized knowledge and the right connections to be able to select the right borrower, the abilities to perform an effective due diligence, be it commercial, financial, and legal, and basically to be able to craft up a deal structure that work in the context of deals that the team is looking at. Now, fast forward today, as what Eric has mentioned, is that the current market environment is highly complex for the reasons that Eric has mentioned, so I will not repeat it. So I think based on the current market situations that we are observing right now, some of the broad trends I think will emerge in this period. One is that lenders will have much more stronger negotiation power today, right? Because the capital market essentially is shut down. IPO, for IPO as well as the bond issuance, is basically at all-time lows in Asia. Not many borrowers are able to get access to from the capital market. Secondly, is the banks are getting a bit more cautious. We do notice that some banks are starting to tighten up their credit, pulling back a bit of their lines, and some banks that have stuck with some underwritten positions, they have reached out to basically to willing to sell at a much deeper discount to offload the risk to other lenders. So I think one is that lenders will have much stronger negotiations positions in this period. The second thing is that in terms of opportunity mix in Asia, I think there'll be a bit of a change. We'll probably be looking a bit more refinancing opportunities, right? There'll be much less growth capital because companies are not really growing in the current moment, and a lot of companies basically will be more cautious in terms of the business expansion. I think we're likely to see a bit more distressed deal in the market given the increasing interest rate, currency volatilities. And we probably will see that some of the banks that have unsold commitment, I think they will basically need to reach out to offload the position and potentially a much deeper discount then. We also will be seeing, I think, some of the higher quality borrower that in normal times that does not need to reach out to the private credit lenders. They will get those access from the banks. But given this time period, some of them may have no choice but to turn to the private capital lenders for that capital during this period. We also going to see that the private credit lenders, I think, is going to be a bit more selective, a bit more cautious, given the market environment when they are making this investment during this period.
Thank you. That was very insightful. And Nitish, what are your views? Do you agree? Anything else you can comment on?
Oh yeah, I think we have very well defined. I think what's going on in Asia, and I think what are the opportunities and the challenges. I'll probably take a little bit more big picture. I think in terms of how we are seeing the trend among the investors the institutional investors, and I think how they are looking at Asia compared to, I think, what they've been doing in say, North America and Europe. I think a couple of things that we are seeing is, I think definitely now institutional investors are seeing a lot more relative value in Asia compared to what they've been doing in US and Europe more specifically. I think Europe, obviously, with the war and so on, is are going through its own set of issues for now. But even otherwise, I think given the competition, which has gone up both in US and Europe with new players coming in the private debt space, I think there has been a compression of yields there. Obviously, the structures are getting lighter in terms of the governance and all. I think you have already talked about it, that Asia, we are still in a different place altogether. So there's definitely a lot more relative value that investors can see in Asia compared to what they're getting in private debt lending in North America and Europe. And then on top of that, given that a lot of the large institutional investors have very little exposure to Asia, it also then becomes a diversification play for them. So one, you see relative value. And then on top of that, it also helps you diversify some of your risk away from North America and Europe. So I think it becomes a very compelling proposition for many of these investors to basically put in some capital to work in private debt markets in Asia. So we definitely see a lot of that already happening. I think we got OMERS, which is a Canadian pension plan, as a shareholder in our firm. I think CPPIB, another Canadian pension plan, have invested significant amount of money through direct lending on their own. We've seen some insurance companies like Allianz who have come and set up their own shop in Asia. So we can definitely see large, sophisticated investors coming into Asia private debt market. And I think it's probably time that Asia market private debt gets its rightful place in the sun. I think today private debt is less than 10% of the total private debt market in the world, whereas Asia GDP or the Asia Pac GDP is closer to 35%. So there's definitely a big gap there. And we think that the time has come for Asian private debt to really, I think, grow from here and get its rightful place.
That was great. And on that note, definitely I'm hearing similar comments from both of you. It is a growing practice. Credit strategies is able to generate alpha. You are both bullish. Now let's take this and turn it around on the investor side for a little bit. Obviously, both of you have very different strategies within the same credit space. How are you differentiating yourself? And from a fundraising perspective, was that easy given the environment we just spoke about? Anything you can share on what are the investors thinking of? Maybe let's start with Nitish.
Okay. So let's see what are the key challenges we see on the fundraising side today, right? I think, again, I think one of the key issues that we have seen is that Asian private debt market is not well researched. So I think whether it's the consultants, whether the fund of funds, I think people haven't really spent that much time looking at Asian private debt players in general, compared to the amount of time that they've spent looking at US and Europe. And the reason, again, is because of the volume. I think for the same bandwidth that they have, they can get obviously a lot more capital to work in US and Europe compared to in Asia, because, again, Asia has been relatively small. So we can definitely benefit a lot more if there can be more research, more, I think, consultants, more fund of funds, I think other analysts who will start covering Asian private debt managers. So I think that would definitely help a lot in terms of giving us wider exposure and helping some of the investors as well who work with these consultants. So that's definitely one thing that would help. Second thing is, again, we don't have any proper market benchmarks to really benchmark our performance, how we are doing in Asia. Compared, I think in US and Europe, there are some good benchmarks available. But here again, I think the investors struggle with benchmark. You say, okay, I'm doing this and this, but how do I benchmark you and how well you are doing or not doing? I think again, that goes into the research part of it. As more research comes in and as benchmarks come in, I think that would again make things easier for the investors to come in. And I think the third thing we have seen, and that is more on the performing credit side, is I think the short track record. I think we were among the first players in Asia to start performing credit, and we are 10 years old. So again, I think unlike some of the other markets, we don't have that longer track record. Investors typically want to see, I think, 15, 20 years track record through the cycles to basically then distinguish good managers from not the good ones. I think distressed debt, there is a longer track record because I think some of the players have been doing it since early 2000s, but I think on the performing credit, we don't have that longer track record. So I think these are some of the challenges that we have seen specifically on the fundraising side. I think the way we differentiate ourselves, again, so we are totally focused on performing credit, and we are probably the only one regional player among the larger players who only do performing credit. We don't do any other strategy. So that definitely has helped us position well. I think it helps us on the sourcing side because people don't see us as a distressed player. And I think given what's going on the macro side that we just talked about, we think it's a much better place to be in. So we're definitely seeing a lot more interest. And I think we continue to be optimistic about future prospects on performing credit.
Great. And Buya, what are your views on fundraising?
Sure. Just adding on to Nitish points, I think one of the big trend that we are seeing is that because of the drop in valuations, the equity as well as the bond prices across globally, I think what we see is some of the institutional LP, I think in terms of percentage of investment in the illiquid space has gone up slightly correspondingly. So some of them are actually in the midst of trying to rebalance their portfolio. So I think that may create a little bit of rebalancing spirit that to go through. So I think for Citown side, where we try to differentiate ourselves with respect to fundraising, essentially, I think I can point out to three factors. So one of the key factors is basically Citown ability to tap on the Temasek vast network to basically let us to achieve two key objectives. One is that through that Temasek network, we are able to build a much more robust proprietary deal flow that we tend to be the sole lenders or the anchor lenders. Secondly, we are able to tap that network when we conduct our due diligence on a company. So we can get access to operating companies that are operating in that country, and we will get on the ground information from an industry player. And that kind of information tend to be real time. It's very insightful. It's very hard to get from market research. And that's really help us to avoid the pitfall, unnecessary pitfall, and also help us to pick the right borrower. And that really save a lot of headaches down the road. Then the second thing is that supported by that network, we have been able to find suitable opportunities even during the COVID periods. And we have been able to keep a steady pace of investment. And with that, we were able to generate quite a good superior risk-adjusted return. So we did a benchmark, our first fund performance. We don't have Asia-Pac data. So what we did is that we benchmarked against the global private equity, private fund database. And I think we are happy to report that our fund is basically ranked at the top quartile on a global basis, right? The third point is that the fund that we run come with very meaningful LP commitment by the Temasek Group. So that actually helps us to achieve two objectives. One is that for at Citown side, we are able to continuously be able in the market to source deal and to execute deal. So it positions Citown as a first port of call with the borrowers or intermediaries because they know that the availability of capital in Citown is continuous. All right. The second thing is that because we were able to utilize the anchor LP's commitment to continue to deploy. So when we open up our fund to third party, so basically the fund is likely to achieve a fairly high level of deployment. So the LP basically with a high visibility of the actual investment made, they can better understand the nature of my strategy and that I'm executing right now and the return being generated from those transactions, right? And by then, typically is that when the LP comes into the fund, the LP does not encounter any J-curve impact whatsoever.
Great. Let's take that as a segue. I want to touch a little bit more on now. We have alluded to the fundraising environment very strong. A lot of opportunities exist from a deployment side. Access and portfolio construction is the top of the mind of LPs investing into this asset class. Credit tends to be more transparent, basically, and liquid in the US markets, right? It's observable, benchmark exists, as you have alluded to. In Europe, that could be a mixed bag, but when it comes to Asia, the exposure in Asia, traditionally very bank-led syndication desk, very on-balance sheet. Asian credits are very hard to measure because the issuers themselves do not like sell downs on the secondary. And these were the traditional way of the Asia markets and how it's reacting. Now, looking at both of you, obviously you thrive in deal sourcing and deal origination very well. But can you share with us some of your challenges based on your core strategy? How did you go about constructing your portfolio as you think about new launches into the future to deploy these characteristics of Asia kind of credit? What are your thoughts? And let's go to Nitish for a start, and then we have Wiyap opine.
Sure. Thanks, Eric. So again, I think we obviously have been running a regional credit strategy, which is focused on Asia Pac. And we think that's the right way to go around portfolio construction in Asia Pac. I think within Asia Pac, you have some very large mini markets. I think whether it is offshore China, India, Southeast Asia, I think Australia, each one of them have their own nuances, and not necessarily all of them are correlated. So if there are issues going on in China, that doesn't mean that you also have issues going on in India at the same time. So I think the fact that you are a regional player and you are able to basically pick and choose investments at different points in time in different geographies within Asia Pacific is a pretty big advantage and a pretty big strength. And that's, I think, so we definitely are a big believer in a regional platform and investing regionally rather than being a country-specific platform and only focusing on a specific country, whether it's Australia or China or India or Southeast Asia. So definitely, I think our portfolio construction is regional. Our book is typically about 60% is India and Southeast Asia. And the rest of the book is Australia, I think East Asia and China. So I think it's a good balanced mix, which I think, again, as I said, is important in terms of portfolio construction. Second thing, again, is we work both with sponsors and non-sponsors. And again, our book is 50% sponsors and 50% non-sponsors. Again, I think during COVID, we saw that I think sponsors had the liquidity. They were able to provide working capital when things just basically shut down and there was really no cash flows coming from the business. So I think the businesses which were owned by sponsors in general had a better ability to, I think, work through the difficult times. So I think definitely all things equal, we definitely like sponsor deals to work with. Again, we focus on medium-term loans. So we don't really go beyond 5 years as a strategy. I think we think the risk becomes too high once we go beyond that. In terms of use of proceeds, about 60% of our loans are for growth capital. And that's not surprising given, I think, Asia still has a lot of demand for capital for growth. We still have very, very robust real GDP growth rates in Asia Pac, which definitely supports growth capital. And the other 40% is typically acquisition financing. I think a lot of that sponsor-driven, a lot of that non-family, I think driven by families, consolidation, and so on. So I think we do both growth capital and acquisition financing. Some of the challenges we see, I think, again, given that Asia is not a homogeneous market, and you've got different legal systems, different regulatory approvals, security packages are different, I think, and different systems work in different countries. So you definitely need to be on top of what works in what country. So the execution times are longer because you typically have cross-border jurisdictions involved in it, which adds to the deal complexity. The good thing is there's an ecosystem coming up of service providers, whether it's on the due diligence side, whether it is on the security agency side, whether it is the legal professionals, which is making life easier. So I think overall things are getting better. But yes, I think the deal complexity, given the, I think, different markets that you deal with, and I think that definitely leading to, I think, longer execution time compared to what you would see, say, a US is one market. I think it's all same language, same laws, same regulations. So I think you can have a lot more cookie cutter solutions there. I think in Asia, we tend to be more bespoke and customized. And that obviously needs more resources, more time to execute, and more complexity.
Yeah, definitely. Point well taken. And especially so on the legal aspect and enforceability, different governing laws. So your thoughts on portfolio construction? What keeps you up?
Sure. Just to reiterate, so in CTAL, basically, we're only investing in performing private credit in Asia. We don't invest in the public bonds segment. So most of the transactions that we've done doesn't come much from the from the bank side. It tends to be a much more less intermediated kind of deal. So some of the deal, actually bulk of some of the deal actually we basically source directly ourselves and we structure it. So how we construct our portfolios, I think we first go off with just basically focusing on each specific transaction by itself, right? We look into the credit fundamentals of borrowers, as well as performance on ESG front to make sure that it passes certain ESG metrics. We basically try to develop, what's the core underwriting thesis for these transactions, and how do we go about to verify or test those investment thesis. Then we put in place what's the due diligence processes that we need to cover, the commercial, the financial, the legal sides. And then we will try to figure out the downside protections that we need to protect ourselves against the identified risks and potential risks down the road. And we will craft a deal structure to make sure that all the elements that we need are put into a tight framework, right? And we also put in a post-deal monitoring process that we agree upfront with the borrowers, right? So once those deals are cleared, when we try to bring out a portfolio, so what we try to achieve to do is that we get sufficient diversifications. We want diversifications across industry. Some industry tend to be have very strong cyclical elements. We try to avoid that, or we try to minimize that, or we try to deal with that cyclicality through some kind of downside protection structure from security or from some various mechanisms to prevent that. Secondly, we also try to diversify across country. We try to make sure there is not a single country that become too large a part of the portfolio. So we try to cap, the large country no more than 30%. We try to diversify as much as possible. Then on transactions that are not US dollar denominated returns, we will hedge it back to US dollar. So basically, we'll try to prevent any FX volatilities from affecting our projected returns. Tenure-wise, we have a slightly different takes from Nitish strategy. We do notice that in quite a lot of deals in Asia, especially from the much larger, high quality borrowers, they tend to be able to access back to the cheaper bank loans after 1 or 2 or 3 years period. So generally, the transaction we've done in Asia in terms of investment to maturity to exit, typically is about a 2-year odds kind of time frame. So at CTAL said, we actually do not mind doing the shorter dated kind of loan tenure, provided it's well structured and the loan side is substantial enough for us to spend our time.
Thank you. And topping up this topic, the common misconception, right, from a lens of an investor would be something interesting to explore just for a little bit. When we talk about private credit, it can span all kinds of underlying asset classes, different legal governing law. As you, Wiyap and Nitish have been saying, different lenses on diversification and exposure. Now, from an investor point of view, looking into private credit, share from your experience, what are the kind of misconceptions you both have had to deal with, right, in the course of fundraising as a little bit more fun, right? Wiyap, you want to start off?
Okay, sure. So I think one of the common perception is that the private credit return it should be lower than private equity fund return. But especially when you read some of the magazine or a buyout fund did a transaction, they get like 3-4 times money multiple and so on and so forth, right? But when you look into the net IR return back to the LP, and when we did our own benchmarking exercise, and we actually found out pleasantly that we actually outperform quite a lot of global private equity fund. I think there are a couple of reasons that kind of underpin that this phenomenon. So one is that generally in Asia, the return generally has been much higher than the US and European market in general. Two, for the private credit fund that Citown run, we actually charge management fee on a deployed basis, not a commitment basis. So the drag by the management fee is almost non-existent, right? Then third, given the scale of the Citown fund and the pace of investments, is actually optimal vis-a-vis the fund expenses that the fund need to run. So the combination of the three actually ends up helping us to generate a very high level of net IR back to our LP. The second misperception I would say is that a lot of people think that Asia is a developing market, so generally the risk is higher, right? So there's a perception. I think quite a lot of the institutions helping the developed markets tend to help. But I think what I would say to them is that Asia is actually comprises of quite fragmented market. There are some developed market, for example, like Hong Kong, Singapore, Korea, and Japan, and Australia. And there are some that's a bit more developing, like Vietnam, Indonesia, India, and China, right? So in those development markets, now, if you were able to understand the market in depth, to try to figure out who's the right partners that you can work with, right? Put in a deal structure that makes sense, understand the regulatory, the enforcement mechanism that's available to you, and put all those elements up front into the deal to protect yourself, to protect the principal. The risk is actually manageable, right?
Great. Nitish, your views?
Yeah, no, I think, again, adding to what we have said, I think the biggest thing we need to deal with is Asia is very risky. And I think that's the first comment that normally investors have. And I think it probably takes them back to their memories of the, Asian crisis, which was like, in mid-90s, or I think some of the more distressed funds that investors may have invested with, which were really trying to target mid to high teens returns. And obviously, to make that kind of returns, what you were doing was really more quasi-equity than private debt. And some of those investments would not have done well. And then I think investors have really branded the entire market as very risky. So I think clearly, first thing we explain to the investors is that there are different pockets of the risk curve in Asia. Yes, there are more distressed special sits, pockets where you can look at making high teens returns, but obviously the risks are higher. But there are also, on the other hand, I think lower risk pockets where you can do direct lending, where the risks are, I think, a lot lower, a lot more manageable. And so I think don't basically use the same brush to paint the entire Asian market as too risky. I think that's number one thing that we would want your audience to take note of. Second thing is, again, I think Asia has changed a lot as well. I think since the Asian financial crisis, I think the economies are a lot bigger now. They are more robust. They are more diversified. The scale is much bigger. I think the FX reserves that the countries have are a different scale altogether than what we had during the Asian financial crisis. So they're just not comparable. It's a different ballgame altogether today. So I think to comparing what Asia was about 25 years ago during the Asian financial crisis is really not fair. And again, during that 25-year period, there's also been a significant improvement in the legal framework. I think a lot of the countries have taken very significant steps to basically improve their legal frameworks, make it easier for creditors to enforce. I think both in terms of I think, certainty of judgments, and also in terms of the timetable in which the judgments can be delivered. And that has, again, definitely helped improve the negotiating position of us as creditors. So I think our request is, I think, don't use the same brush across Asia as very risky. I think, yes, there are risky pockets. If you are targeting high mid-teens returns, then yes, you need to be on that side of it. But there are other pockets which are low risk, more performing credit. And Asian countries at a macro is in a much better place than what it used to be in the past, including the legal frameworks.
Great. Very insightful. And using that same analogy on the brush stroke across the region, not only just misconception, the investors, right, are different. You have alluded to, both of you, very sophisticated pension fund and LPs that have already been investing in you, very, very experienced. They know what to expect. But using the brush analogy, there are some, like insurance companies that we are talking to, and I'm seeing myself, they are traditionally very private equity. And even then, the allocation is through a committee which is externally sourced. Direct access, even in private equity, remains a challenge. Maybe to round it all up, right? I will ask both of you to give an overview on what are the things that investors should be looking out for on the end of that brushstroke, people that may not have invested in private equity before, or thinking about it, but may not have that kind of experience that we are alluding to today as a collective. So maybe I'll invite Wee-Up to tell us some words of advice for all the investors out there as we close this chapter today.
Sure. I think it's fairly similar how an LP should look into in all alternative fund, right? So first is that the track record of the fund and the consistencies of that track record over a business cycle, not just good time, but bad times. How has that portfolio performed, right? Secondly, is trying to identify the team member that contribute to the historical track record and the stability of the team composition to make sure that the underwriting thesis of the track record, can continue to go forward. Third, this is probably a little bit more towards Asia, is that team's ability to negotiate and structure deals. What you find in Asia as compared to the US and European market is that Asia private credit deals tend to be heavily customized. There's no cookie cutter standard. It pretty much depends on the investor and the borrower to negotiate a term. So the team ability to negotiate and get back, the stronger your ability, the better the terms you can get, right? And the fourth, I would say, is that look at that team's ability to manage weak or non-performing investment. Have they follow up that investment closely? If they notice that the investment is not doing well, have they been timely and take effective actions that are available to them to manage that situation, and what's the outcome of that situations?
Yeah, Nitish?
Okay, so again, I think just to add, I think what are the key factors for success for us, right? So I think one is definitely the sourcing is most important. I think your ability to see more deal flow, and then you can pick and choose what investments you do. So I think a team which has the sourcing networks, who have the experience and have built that network, definitely would do better. I think we, for example, we only have our angel-led model. So I think all transactions we do, I think, are led by us. So that definitely helps. Second, I think local knowledge is, again, very important. We talked about how each of the markets are different. I think different securities, different tax laws, how the withholding taxes work, how the regulatory regime works, what security packages work in which markets. So I think having the ability to basically have dealt with different issues in Asia, so what may work on paper may not work in practice, but that really you learn with experience. And that's why I think having the experience, being in these markets through the ups and downs, I think definitely is very, very valuable. So you just cannot parachute some very smart people from non-Asian markets and hope that they will do well. I think they may be great professionals, but they would not know the nuances of the Asian market just because they haven't spent enough time looking at things here. I think third thing is the investment discipline. I think we have seen so many people get it wrong on the investment discipline. I think you have a lot of pressure to deploy capital, and then you start basically doing things which are at the edge, and then you really go down a slippery slope. I think so having that investment discipline to see what you want to do and what works for you and not get, I think, swayed by other factors is, again, very, very important, which we've seen. A lot of people fail that test there. And I think finally, it's all about the numbers. I think the numbers speak for themselves. So look for managers who have a strong track record of delivering the performance through the ups and the downs. And the numbers tell the story as well. So I think that's really, I think, the four things that I would advise the investors to look for.
Great. Weeyap and Nitish, this has been a very fruitful discussion on private credit as a strategy, which I'm sure will resonate with investors. I'm Eric Chung from State Street, and I want to thank you both for joining us on this panel today.
Thank you. Thanks, Eric.
Thank you. Thanks, Eric.